Welcome to Talk Tickers. Today, we are digging into the third quarter earnings for Scripps. Now, on the surface, it looks like another really solid quarter. But when you look underneath, there's this battle raging between some pretty impressive operational wins on one side and some serious market headwinds on the other. We're going to break it all down and figure out if this is a stock that's ready to fly or a trap just waiting to spring. So that's really the crucial question for any investor looking at this, right? Is Scripps a genuine turnaround story with a ton of upside? Or is it a classic value trap, just caught in the crosswinds of a really tough advertising market? Let's start with the hard numbers from their latest report to see what's going on. So, for the third quarter in a row, Scripps delivered a really strong earnings print. They either met or beat expectations pretty much across the board. This isn't just a lucky break. It's starting to look like a clear pattern of disciplined execution and some very tight expense control. And when you look at the key metrics, you can really see a story of resilience here. Local media actually outperformed its peers with almost 2% growth. But the real headline, the one that just jumps off the page, is that 41% explosion in connected TV revenue. That shows they are successfully capturing the streaming audience, which was just enough to help their broader networks division hold flat in what is frankly a brutal national ad market. So, what's the playbook here? What's the strategy? Well, it really starts with fixing the balance sheet. Management has been absolutely laser-focused on one thing, using smart M&A to optimize their portfolio of stations and aggressively pay down their debt. And here's the proof that it's actually working. They sold 2 stations for $123 million in cash. But look at those multiples on the left, 9.2 and 8.5 times. In today's market, those are absolutely premium prices. And it proves they can unlock some significant value from the assets they hold. And here is the direct payoff from that M&A and their strong cash flow. Net leverage has dropped all the way to 4.6 times. That is a huge step down from 6 times just a year ago. They're successfully de-risking the balance sheet, which was a key demand from both management and investors. And management is signaling that there is more of this to come. The CEO, Adam Simpson, was totally unequivocal on the call. He said, "We are absolutely committed to doing the work necessary to unlock and maximize shareholder value." And then he added, period. That period at the end, it tells you everything you need to know about their aggressive stance on optimizing this portfolio. But fixing the balance sheet is only half the story. On the other side of the ledger, Scripps is busy building some powerful new growth engines in sports and streaming. They're trying to fight back against those broader declines we see in traditional media. First up, sports. Their total sports upfront advertising volume was up over 30%. And let me tell you, this isn't just a minor win. This is a home run. Their early and really aggressive bet on sports, especially women's sports, is paying off in a huge way. And then you have streaming. Like we saw earlier, connected TV revenue exploded by 41% this quarter. This shows they're not just playing defense against cord cutting, they are actively monetizing that big shift over to streaming platforms. And look, this isn't just some abstract growth happening. Revenue from the WNBA on their ION network, it nearly doubled. They're adding new local NHL deals. And as you can see, streaming now accounts for a full 20% of all their networks viewing, with deals like the one with Peacock expanding that reach even further. It's a true multi-pronged strategy. Okay. But this is where the story gets a little complicated. The company's guidance for the fourth quarter was, it was mixed, to say the least. And it introduced a major note of caution and really highlighted the challenges that still remain in the ad market. This slide shows the split perfectly. It's really a tale of 2 different businesses. On one hand, local media is guided to be up around 10%. That's a fantastic number. But on the other hand, the national-facing Scripps Networks division is guided down in the low double digits. That is a stark contrast, and it's what really spooked the market. So, what's behind the weakness? Well, as this slide shows, it was kind of a perfect storm. They're facing a really tough comparison or comp against more than $10 million in political ads from last year. On top of that, the ad market outside of sports was softer, with some very specific weakness in pharmaceutical and Medicare ads. Okay, so this brings us to the next call. To figure out our rating, we have to weigh these impressive operational wins against these very real, very tangible market challenges. The bull case is pretty clear. Management is executing flawlessly on deleveraging. They've got high-growth assets in sports and CTV, and there's a huge political ad year coming in 2026. But the bear case is that the weak Q4 guidance for the networks is a huge warning sign of a persistently soft national ad market and just broader economic uncertainty. And this brings us to let's call it our outrageous but plausible trade idea, a bet on transformational M&A. Here's the catalyst. Management expects the FCC to eliminate the national ownership cap by mid-2026. Now, once that happens, Scripps, with its much cleaner balance sheet, becomes either a prime acquisition target or major consolidator itself. A long position in the stock is effectively a call option on that industry-altering event. Now, despite that really compelling long-term thesis, our official rating is market perform. The execution on the turnaround is undeniable. It's impressive. However, that weak Q4 networks guidance highlights some near-term volatility that we just can't ignore. We really need to see sustained improvement in that national ad market before we can turn more constructive on the stock. And as always, remember, this is not financial advice.